Hi, everybody. This is Josh Jelinski, the financial quarterback, here with one of our favorite guests of all time, Dr. Lacy Hunt. For Lacy, your podcasts are the most, I want to give you credit here. You are beating out John Malden. You are beating out Robert Kiyosaki. You're beating out Tony Robbins as some of the most downloaded podcasts of all time on New York's WOR 7 to 10 a.m. You are 6th or 7th behind Charlemagne the God in New York. So New Yorkers love you. Did you know that?
I had no idea. No, none whatsoever.
So you're apparently a bit of an icon in New York. And so it was funny. I just stumbled upon this. How did I find out? I don't get a lot of stats. But we were looking and they were saying, well, who did you have on April blah, blah, blah? And it was you. And it was just, it was fascinating how you got more listens than just about, I mean, we've had some big name guests on. And it was, you know, I think it's a lot of the New York hedge fund people, the financiers listening, you know, the people managing money maybe, and then they're sharing. And your interview even went viral in the Bitcoin community. Apparently, you're very popular with the Twitter guy, Bitcoin Tina. Have you ever heard of him?
No.
He's kind of famous in the Bitcoin community. And Joe Carlasari, big attorney in Illinois. So all these people on the Twitterverse and in Clubhouse. So we got to get you on Clubhouse because they love you. They're doing rooms. Did anyone tell you this?
No, I'm totally non-conversant.
They're doing rooms about you in Clubhouse. And I popped in about our interview and about your interview with the Raoul Paul interview went kind of viral. So it's interesting. I didn't know you knew that, but I didn't know you didn't know that, but it's funny that I'm the first to tell you. So in your prior interview with us, well, actually, for people who haven't heard of Dr. Hunt, talk about your background briefly. And I didn't even know you're in your 70s. I thought you were in your 60s. So you're looking good.
Well, thank you. I earned my PhD from Temple University in 1969 and went into the Federal Reserve at Dallas, and chairman of the Federal Reserve Board was William McChesney Martin. And when I left the Federal Reserve to go into the Chase organization, Arthur Burns was running the Fed, and Chase in those days was run by the venerable David Rockefeller, who I had the pleasure of doing some projects for.
Wow. And now you're the executive vice president and chief economist of Hoisington Investment Management Company. And they manage about $6.12 billion for pension funds, endowments, insurance companies, big into consultant to the Wasatch-Hoisington Treasury Fund. It's been a great fund over the years, although we're not recommending you buy or sell anything based on listening to us. He's the author of numerous books. And in the last interview we had with you, kind of went viral. People were really into it. People told me in the comments to shut up more and let you finish your sentences. It was funny. People were just nasty in the comments. I said, this is a radio show. If you have an economist go for an hour, you got to have some regular guy on the street. So I'll try to shut up more. But in the prior interview we had, you stated your view that the burst of economic growth that we have is because of the increase in monetary supply that has already peaked for the year. Assuming that's true, do you anticipate policymakers will expand rather than contract the money supply if economic conditions begin to deteriorate in Q4 2021 or Q1 2022?
Well, my view at the time was that we were experiencing the peak growth for the year, and that economic conditions would deteriorate as we move forward, and I absolutely believe that is happening. The economy slowed to a crawl in growth we had appears to have been only in the inventory component of GDP. And there has been a major decline in all of the big ticket, high multiplier sectors. Consumers have turned very sour. Their expectations for income growth have dropped very dramatically. And this has pulled the buying plans for cars, appliances, and houses down very sharply. And the economy is facing a difficult path forward, in my opinion. And the basic problem that I saw earlier in the year, which we continue to have, which we've had now for several decades, is that the U.S. economy is grotesquely over-indebted. And when we take on more debt, it can give us a temporary spurt in economic activity, but the spurt dies out very, very quickly. When we take on debt, for it to be effective, it must generate an income stream to repay principal and interest. If it does not, it creates the condition that described by the late Hyman Minsky of Ponzi finance. Now, it is so far this excessive indebtedness has not led to the instability foreseen by Minsky, but the effect is more insidious. The growth rate that we've been experiencing since 2000 is falling well below the trend that we previously had. From 1870 to 2000, we grew about 2.2% in real per capita GDP terms. Since then, the growth rate has only been half that. If we had maintained the long-term historic trend rate of growth through the second quarter of this year, our per capita real GDP would be about $73,000, but the actual was only about $58,000. So the economy has not been just underperforming for the latest expansion, but the underperformance now has been going on for more than 20 years. And the corollary aspect is that the same condition of extreme over-indebtedness is even more serious in Europe, Japan, and China. And those economies are doing very poorly. Sequentially, from the second to the third quarter, Chinese growth is flat. Japan is most likely negative, and Europe is in the doldrums. Whether we or Europe have the slowest performance, that remains to be seen, but there are really no bright spots in the world. And the condition that we have is we're in a debt trap. We have too much debt, too much of the wrong type of debt. We keep taking on more debt to solve our indebtedness problem, and the results get weaker and weaker.
Wow, this sounds a little depressing. It sounds like we're getting ready for Halloween. with Dr.
I
Hunt.
don't try to be depressing or optimistic. I'm in the investment management business. I'm trying to look at the situation as the facts state.
A realist.
And
a realist, if you will. So let's take our first break of the hour. This is Josh Jelinski, the financial quarterback, with Dr. Lacy Hunt. Give us a call at 888-988-JOSH, 888-988-5674, and we'll give you a free 45-minute ultimate financial game plan when you schedule and keep your no obligation review. We'll be back after this. And we're back with Dr. Lacy Hunt, talking about the economic doldrums, depressing. I gotta confess something. I was gonna buy a beach house during our last interview, and your sort of depressing forecast made me believe that the inflation we were seeing was indeed transitory and we're going to have deflation. I would say, if I'm a betting person, 12 to 18 months, the market will start to go down. 24 months, maybe if the Fed can keep things propped up, but eventually things will go to hell. And it'll be better to buy real estate in 5 years. That's what I got from your April interview. that we did. Would you say I'm right? Because if indeed all this is transitory, then you should wait a few years to buy, right?
Well, I don't like to give advice, but I will tell you that inflation and interest rates are a lagging indicator, and they have been since the classic work of Wesley Clair Mitchell and Arthur Burns, who established the National Bureau of Economic Research. When you come into a recovery, alpha recession, the inflation and interest rates need to go lower. And if they don't go lower, then basically it erodes the capacity of the economy to grow further. Unfortunately, the economy has been hit by a series of supply-side shocks. In technical economic terms, this means that the aggregate supply curve is shifting inward. And when it does that, it leads to higher prices and weaker economic activity. This isn't just a historical phenomenon. There's strong rationale for it. In inflations, prices outstrip wages. And when that happens, then folks are required to shift funds from discretionary purchases to non-discretionary purchases. And that serves to contract economic activity. In addition, when inflation rate rises in the early stage of an expansion, you don't get the decline in interest rates, which the economy needs in order to gain traction. And also, when inflation kicks up, it leads to a rising trade deficit, and that cuts into economic activity. And so the timing in these matters is never certain, but the supply side shocks create their own conditions for reversal. So you get higher prices, but you get lower level of economic activity, but the output gap then increases, the gap between potential output and the real level of spending. And so consequently, we begin to erode it. Now, in the current situation, there's another event that's taking place, which I think will also work toward reversing the process, because even though the U.S. has slowed dramatically in the third quarter, the situation, as I said, looks worse overseas. And the dollar is in the vicinity of a one-year high. Well, when the dollar goes up, that tends to transmit the problems of the rest of the world into the United States. And so the inflation rate is high, but I will tell you this, if it does not abate, then economic conditions will continue to deteriorate.
We had Dr. Ranson on last week, a noted economist, and he was saying something to the effect that the real inflation rate, he agrees with you for different reasons and he has different work, but he was saying like I might be botching this, but like the short term, he wasn't hopeful on the prospects either, but the short term inflation rate, he put it like 20% or something. Is that? No,
I personally think the statistics calculated by the Census Bureau, the Bureau of Labor Statistics, are very reasonable. Okay. And I've studied them myself, and I accept. Could the statistics be somewhat better? Yes, but generally speaking, they're pretty close to being accurate in my opinion.
I may be botching what he was saying. I have to go back and listen to that. But basically, so you still believe inflation is transitory. When does this, I talk to realtors every day. I talk to people in real estate. Real estate is still booming all across the country. There is a bit of a slowing, but it's kind of normal. It's fall. Things are cooling off in the housing market. But it's still like, talk to my friend in, it could be Florida too. New Jersey, real estate is at all-time highs. Florida, all-time highs. Buying vans. I have 7 kids. I don't know if you know this, Dr. Hunt. a large passenger van that we bought for 40 grand is now 60,000. So when will that cool off?
Okay, here's the basic problem. There's no question that housing is at a very high level. The issue is what happens to the rate of change at the margin. And the best leading indicator that I'm aware of are the mortgage applications for purchase. And they peaked actually in early January. And as of the week ending last Saturday, they're down about 20%, slightly more than 20%. So yes, they're at a very high level, but there's no forward momentum. And the real difficulty is that if you look at the relationship between home prices and household income, the two normally move in lockstep. In other words, your income determines your affordability along with interest rates. Right now, the home prices nationally are 30% above household income. Mm. So if you want to buy into that, be my guest.
So your advice would be wait on buying a house, although we're not giving advice, but now might be not the best time to make a purchase.
Well, you've got a major discrepancy. When the housing market was very overheated back in 2006, 7, and 8, household income was about 20% higher than home prices. So there is a major discrepancy there. Now, I will say this, that, and I'm not a real estate expert, and I shouldn't even be getting into this, but there are vast regional differences. And what is happening in the United States today is that there is a major demographic shift
to Florida,
from
Texas,
the East Coast into the low-tax, pro-business states. And in those states, the demographics are extremely powerful. Unfortunately, as folks are leaving the two coasts and moving into these lower tax and more desirable from a business standpoint, it's leaving holes, in my opinion. So there are regional issues, and I have, and in the final analysis on the local level, you've got the local demographics and the national business cycle, and you have to be able to weigh both of them.
No, yeah, good point. So we're with Dr. Lacy Hunt, noted economist of Hoisington Investment Management Company. And when we return, we'll ask him about Bitcoin. I don't know if you know this, Dr. Hunt, but you've become a bit of a Bitcoin celebrity. I really...
Oh, I can't answer questions on Bitcoin.
No, I just want like a few minutes because it's interesting. People really love you in the Bitcoin community. So I want a two minute response to that. Then we'll get to some of the questions talking about Treasuries, where you think they're headed. The 40-year cycle in Treasuries, is that a good predictor in your opinion? And more when we return. This is Josh Jelinski, the financial quarterback. Give us a call, 888-988-JOSH, for the 45-minute ultimate financial game plan. And we're back. This is Josh Jelinski. So, Dr. Hunt, I don't know if you know this, but the whole Bitcoin community goes crazy over you. Some of them don't, but I think why is we talked a little bit about this last time, in that now Bitcoin is inflationary, right? It's sort of acting, but in actuality, the thesis is deflationary. So it could work if we had this deflationary spiral. Give us your 2-minute thing on Bitcoin, then we'll talk about something else.
Well, I really, our firm is SEC regulated. We have to operate under a code of ethics, and
sure.
And so we don't make financial recommendations outside of the Treasury market.
Oh, totally.
So I really cannot go there, and I have to pass on your question. I'd love to help you, but I don't have direct expertise there, Josh.
Sure. I think there are implications in what you say for Bitcoin as an asset that is, for example, if we have inflation, right, you would think gold would go up, but gold is, as you know, gold suffered of late. And one response could be, well, now Bitcoin is sucking some of the money from gold bugs, you know, things like that. That's more what it's getting at.
Well,
So
one of the things that I've done over the years is I was an econometric model builder, built large-scale econometric models, and I've fit functions for all kinds of relationships. And I can show you historic examples when gold does very well in deflation and then again in inflation. I can show you situations where the opposite is true. Gold doesn't do very well in inflations and it doesn't do well in deflations. And so the relationship is not stable. And so what economists like to be able to do when they're fitting an econometric function, they like to be able to estimate a demand function and a supply function. And the fact of the matter is, we can do fairly well at estimating demand, but we cannot estimate supply. And so that leaves my skills as being inadequate to the task of the job. I have to be candid with you.
well, I actually think what you said has implications because demand and supply function, if you take Bitcoin, for example, we're not giving any recommendations on that, but there's a fixed supply of an asset that...
I'll tell you one thing that may be at work in a lot of markets in a hidden sort of way. As economies become more and more indebted, and there has become an integration of monetary and fiscal policy together. That was not the way our system was designed. The way we were designed was to keep monetary and fiscal policy independent, system of checks and balances, so that mistakes in fiscal policy would not be complemented by, but countervailed by sound monetary policy. So what is happening, and I think that this may be an influence that we need to be more aware of, as we're becoming more indebted and monetary and fiscal policy are becoming more intertwined, this action is moving the United States and other major economies further and further into a command and control economy. Well, that has implications because as the government sector rises, the private sector has less of the pie. But it's the private sector that has the high multiplier activities. And the government sector has the low multiplier activities. And so as we move further and further toward this command and control economy, what we're doing is we're enfeebling the overall economy's capacity. And that process may be at work influencing markets in ways that none of us fully understand.
Yeah, that's what I was getting at. So that's good. Or in a way. So why is it that people don't get that? Why do people not get that the mark? To me, it's like common sense. If the government invests in shovel-ready projects, remember in 2009, I always use the same example.
Yeah.
I live in New Jersey. You ever been to the Jersey Shore?
Many times. I lived in Basking Ridge, New Jersey for a long time when I was working in the HSBC organization.
So you're driving down the beautiful New Jersey Shore. There's nothing like it. And driving to Cape May or something, or Ocean City, they built one of these shovel-ready projects on the bridge to Ocean City, and then they built it on some bridge to nowhere on the Garden State Parkway, which, by the way, is like a road funded by state tolls. So it really doesn't make sense of how federal money to win all these places. And they built this beautiful bridge, and they didn't even expand the lanes from 2 to 3. or they're making these beautiful murals of seagulls, and I mean, it's just whenever the government spends money on anything, it's filled with waste and prevailing wage and fraud. So to me, it always made sense that if the government spends money, you have less of a multiplier effect. If a private person invests their own money, they're going to be cheaper, they're going to be more frugal, and you're going to have a more multiplier effect. That's how I view it. I'm not an economist. So to me, it always made sense, but people just don't get that. Because the minute there's a problem in the economy, they go, government, save us.
Could I just add?
Yeah, go ahead.
Could I just add to that? The shovel-ready projects of 2009 and 10 were debt financed. The tax cuts of 2018 were debt financed. The $5.5 trillion of pandemic relief, debt financed. What the serious academic research shows is that when you have these debt finance projects, the economy gets a benefit that lasts only about 3 months, maybe a little bit or a little more. And then it begins to wear off. And as at the end of 3 years, there is actually a negative government debt multiplier. It's not positive. Because what happens is that the private economic activity declines by more than the dollar of debt finance government activity. And so when we take the debt on, it may be politically popular, it may be socially appropriate, whatever you say, but the fact of the matter is the debt has this deleterious consequence for economic growth. And one of the main consequences that I believe is as a result of the $5.5 trillion that was taken on since the spring of last year, that this is going to have an adverse effect on growth, and it means that interest rates are going to have to stay low for longer. And this is going to surprise a lot of folks.
So let's talk about interest rates, but why? But before we do, why do you think that's the case? Why does debt, or as an economist, you just study the numbers and...
Okay, it's a fair question. Okay, so one of the most important fundamental concepts in economics is the law of diminishing returns. And the law of diminishing returns says that if you begin to overuse a factor of production, such as debt capital, initially GDP will rise. But if you continue to overuse debt capital, GDP flattens out. And if you still overuse it, then it declines. In other words, you have increasing returns, flat returns, diminishing returns. And so we're talking about a nonlinear relationship, which is really hard. People assume that more should be more, that economics is accounting. It's not accounting. If I were a physicist and told you that you had to accept a nonlinear relationship, you wouldn't like it, but you would say, yes, I can understand that. But in economics, you're dealing with the law of diminishing returns. And the way one measures diminishing returns is by the marginal revenue product of debt, which is the amount of debt, the amount of GDP that's being created per dollar of debt. And what's happening is that we used to generate, depending on which measure you use, 70 or 80 cents of GDP growth for every dollar of debt. And now we're generating 15 cents to 20 cents, which is confirmation that the law of diminishing returns is at work.
Wow. Folks, this is Josh Jelinsky, the financial quarterback, with Dr. Lacy Hunt, one of the most podcast downloaded, one of our most popular guests of all time. More popular than the guy who wrote more books than it's amazing. You've become a phenom on the show. So if you miss any part of this interview, we're on YouTube. We are on iHeart Podcasts. We're on Spotify now. Make sure you download it, share with all of your friends, and call us 888-988-JOSH for the 45-minute ultimate financial game plan. We'll be back after these messages. We're back. This is Josh Jelinsky, the financial quarterback, with Dr. Lacy Hunt. So Some would say the stock market is contradicting your views. There are people who, they study your work. They might say you're a bit bearish at times. What do you make of the stock market gaining all-time highs?
I think the stock market is an extremely poor economic indicator. The Treasury bond market is controlled by fundamentals over time, not day to day, week to week, even month or quarter to quarter, because you have so many psychological influence trading schemes, various heuristic models at work, but the fundamentals do prevail. The macro fundamentals prevail in the Treasury markets. However, the stock market has become a very, very poor economic indicator. I cannot find stable relationships with the macroeconomic indicators. And I think that the reason for that is the situation that we've created with too much debt. When economies are extremely over indebted, the velocity of money falls. And people that do monetary analysis, they look at the rate of growth in the money supply and assume that is the key thing in terms of making an economic assessment, because Professor Friedman said that inflations are always and everywhere a monetary phenomenon. But if you look at Professor Friedman's algebra and his elegant mathematical work, he made it very clear that this was under the assumption that the velocity of money is stable, which it was when Friedman was doing his research from the 50s to the early 80s. But since then, velocity has been more erratic, and it's declined as we become increasingly indebted. And so what is happening is that the declining marginal revenue product of debt is dragging velocity lower. And so what happens is that the increase in the money supply, which the Fed can still engineer with greater difficulty, but they can increase liquidity. But when velocity declines, that liquidity is trapped in the financial markets. And it results in a bidding up of financial asset prices and bidding down of the return on financial asset prices. But the liquidity does not make itself into creating a higher standard of living. And that's why we see that the actual rate of growth since 2000 is less than one half of what it was from 1870 to 2000. And so the stock market is a liquidity barometer. It's not a macroeconomic barometer. And I will tell you, as someone that's interested in the fixed income markets, I have to basically ignore the stock market because it's not an indicator that will reveal macroeconomic developments.
So you could say you really don't know where the stock market's headed because it's sort of divorced from the business cycle. There is no business cycle anymore, and it's sort of divorced from reality.
It is, and it's not important to me. I mean, for example, if let's say, because you can read the stock market on your screen constantly, if you thought it was an economic indicator, you might think the economy is doing well and that the standard of living is improving in the same way that it normally has, but it is not. And take, for example, I mean, the stock market is in the vicinity of an all-time high. Yet what happened in the third quarter? The economic growth rate collapsed compared to what it was in the first and second quarter. I'll tell you another thing that is happening in the third quarter that would in the olden days before we became so over indebted would have been picked up by equity investors. So you have a relatively modest gain in GDP. The Atlanta Fed says it's a little bit more than 1%. the labor inputs, the rate of growth in employment and the work week, were at a 5% annual rate. Well, that means that output per worker declined at about a 4% annual rate. Well, that shouldn't be happening. And when it does happen, what it means is that corporate profit margins are being squeezed very hard. And the drop in productivity is not important to the stock market, but I will tell you something, as a macroeconomist, the big erosion in productivity in the third quarter has very negative implications for the economy moving forward. In other words, there is no substitute for getting involved in the basic macroeconomic relationships.
Mm. Well, I think it's interesting. It popped in my head that the main drivers of the stock market, particularly since 2016, Fangmant, Facebook, Amazon, Netflix, Google, Microsoft, Apple, Nvidia, Tesla, are in some ways, with the exception of, I guess, Tesla, deflationary by nature type stocks. So I guess that would be the only thing that sort of makes sense. You get what I'm saying? Meaning Facebook is free. Google is free. They're selling our ads, but in essence, now we're being entertained for free. I mean, we're buying a phone. Even if you think T-Mobile, that stock had epic growth over the last so many years by slashing prices from the Verizon or the legacy systems. So I guess you could say it makes some sense in that the stocks with the biggest growth over the last 10 years, Amazon is sort of deflationary, lowering retail costs. I guess that would make some sense, right?
Let me answer that question because it's a very profound insight. We all know that productivity and technological advance have been with us from time immemorial. We're experiencing in many, many ways unbelievable technological advances. However, the technology that we're experiencing, and represented by the companies that you mentioned, and as well as others, is really fundamentally different from the type of technology that we had during the heyday of American economic growth from 1870 to 1970. During that time period, the main innovations were the combustion engines, the transmission of electricity, modern sanitation, communication, and the development of pharmaceuticals and chemicals. Now, those were revolutionary technological advances. And so think about building the electric grid once we knew how to transmit electricity. Edison gave us the insight in the late 1800s, but we didn't complete building the grid until after World War II. But in so doing, that required a lot of labor and capital and natural resources. The technology that we're experiencing today, and which is attracting investors, is more evolutionary rather than revolutionary. So we are finding a way to check people out of the retail establishments with machines rather than people. We're finding a way to substitute robots on the assembly line instead of using people. And so the technology that we're experiencing today does not enhance the demand for the other factors of production. In other words, it's wondrous, it's new, and it changes our lives, but it doesn't give the economy the boost that it gave when it was a more comprehensive type of technology.
Yeah, that's a powerful insight. Only here.
And by the way, I wish I could say that I originated that argument. That was developed by Dr. Robert Gordon at Northwestern in a wonderful book called The Rise and Fall of American Economic Growth. if you haven't read that book, it's an important book to read.
Well, I got to. Well, that's a good guest idea. So producers, get him. That sounds like that's a great insight, though. I mean, because that, I guess, is how it makes sense. The deflationary stocks are, in essence, the ones that are growing, and that's maybe how it all makes sense. So we'll take our final break of the hour with Dr. Hunt. I'll ask him about his favorite thing that we never really talk about when he's on, Treasuries and the Treasury markets. When we return, this is Josh Jelinski, the financial quarterback. Don't touch that dial. And we're back. So in this final segment, nobody, I guess people ask you about Treasuries, but I have a friend of mine who loves the 40-year Treasury cycle. Are you a proponent of that or not?
No, because, they say it's 40 years because the yields peaked in 1981 and have been moving irregularly lower since then. And so we've gone 40 years hereby it's over. But if you look at the business cycle, and if you go back to 1800, you'll see that the 40-year interval doesn't really hold. If you look at the British experience, which is even longer, there's nothing magic about it. The critical elements, I think, that are at work are the debt cycle. And so we had the following debt peak bubbles. We had one in 1838. The next was 1873. The 1838 came after the building of the early steamship lines and canals. There was over-speculation, over-investment. Martin Van Buren was president. He was overwhelmed by it. He didn't know what was happening. The next one came in 1873. That's not 40 years. Grant is president. That the debt was mainly taken on to finance the railroads and the other industries that fed the railroads, also over-speculation, over-investment. Then after the 1873 debt peak, it was 1929, 1930, same type of process, different types of debt instruments. And then we come to 2008, 2009. Unfortunately, as a result of the pandemic, the debt bubble peak of 2020 exceeds the debt bubble peak of 2008, 2009. And this is what happens when you're over indebted and you try to deal with economic problems that arise, and you take on more debt, and they make you happy, but only for a very, very brief period of time, and then you have the consequences of the debt working out for many, many years to come. So the 40-year cycle, in my view, is not at work here. It's whether the economy is relatively indebted or unindebted. But one of the reasons that we, generally speaking, had a rise in interest rates after World War II is that World War II, contrary to what many people believe, was a time of austerity. We had mandatory rationing. People were paid to produce goods for the rest of the world, military equipment and the like, but they could not spend it. You couldn't buy 4 tires if you wanted to. You might be able to get one. Everything was rationed. And so the household saving rate went up to 25, 27% of net national income, and we paid off the debt of the 1920s and 1930s, and you had a normal business cycle. But by the late 1980s, we had surpassed the debt levels of 1929, 1930, and of course, since then, we've gone even higher.
And that's a shame about COVID, right? Because COVID could have been the opportunity for austerity. People were saving, they were living on less, obviously due to we were thrust upon. I remember you brought this up a year ago when you were on, and I'm like, this can be that opportunity to have this kind of reset. And instead we just plowed, we spent 5-6 trillion. Some estimates it's 11 trillion. I've heard, it's just astronomical. the amount of indebtedness we're taking on. If you think about the bailout of the corporate bond ETFs back in March of 2020, it's just a shame, but you know.
And you see, this is the point that I was making earlier for Minsky, that debt has to generate an income stream to repay principal and interest. And when it doesn't, then you have consequences. We all know that when individuals that become over indebted, businesses, state and local governments, banana republics, they pay for it. When you are the reserve currency of the world, you find a way to patch it together, but the debt is like a tax on growth. Doesn't necessarily create the instability that Minsky talks about, but it grinds away. And so the standard of living becomes increasingly frail in its rate of growth. As that happens, it leads to a deterioration in demographics, which is another problem that's occurring in all of the major economies. And so the negative demographics then interact with the debt, and you get into a process that's very difficult to get out of.
I've said that a while ago. We got to be paying people to have babies. And that's the other thing. I don't even get any of these. I have 7 kids. I don't even get these, this stimulus gave money if you had kids. I didn't get any of that, so we should be giving scholarships to kids, to parents who have more babies, because that's the only thing that'll get us out of this mess, right?
Well, but here's the problem. That on the surface, that's a good idea. But let's say that we do that. We have to take on more debt then, Josh.
Yeah, well,
and when you take more debt, that pushes you further along the diminishing returns curve. You see, we're not paying from it out of existing resources. We have to resort to more debt to encourage people to have babies.
That's a good point. I agree with you there. I'm all for not adding any more to the debt. It's just, I remember when Democrats and Republicans in the 90s wanted to eliminate the debt, and that was like the major issue, I guess, due to Ross Perot. He kind of made it popular.
Well, actually, there was a constitutional amendment proposal that came up in the early 80s, was supported by a majority in both the House and the Senate, also by President Reagan. It passed the majority in the House and Senate, but it didn't get the 2/3 vote needed to go to the states. And so, yes, there was an awareness of the debt problem, but we didn't fix it, and we let the situation get out of hand. I think that one of the critical elements in this process of becoming over indebted actually relates to President Nixon's decision to float the dollar in 1971. Up until then, when you pursued policies that were deleterious to economic activity, there would be a gold outflow. And the gold outflow would then make the front page of all the local newspapers, the media, the Wall Street Journal, and the discipline of the dollar would serve as kind of a servo control mechanism to try to keep fiscal policy in order. But after Nixon floated the dollar, then we lost that last bit of control.
And now we're done. Yeah. So, looking forward, do you have any predictions on the stock market or no? Because it's not really what your work suggests.
No, I can't go there. But I do think that if you're a long-term investor and you're prepared to deal with the volatility, that we have not seen the end of the bull market in Treasury bonds.
So
we're still pattern. Rates can go up over the short run for a whole variety of reasons. We've seen a lot of those things happen this year, but in our opinion, the economy is too fundamentally weak for the rates to stay up. The trend is still downward.
And when do you think that trend will end?
not so long as we continue to move along this high debt path.
I mean, in my mind, as I envision this, I see low rates for as far as the eye can see until we have sort of a general consensus. Maybe it's the rise of CBDCs. I had economist Larry Kotlikoff on last week. He was talking to some Swiss person at the Swiss bank, and they were saying CBDCs are on the rise and how in trade, Switzerland can trade. I mean, this isn't my area of expertise, but basically, you used to have to convert everything to dollars, and now with CBDCs, you may not have to. Any comment on that? I mean, because that would be very bad for the U.S. economy if we're not the
Well, one
reserve.
of the things that we must understand is that the Federal Reserve is lender of last resort, not spender of last resort. The Fed can create liabilities, but those liabilities are not money. For something to be money, it must be a medium of exchange, store of value, and unit of account. The Fed's liabilities, which remain on their books, are not money. But the risk to our current system would be a change in the Federal Reserve Act. And there are people that would like to change the Federal Reserve and make the Federal Reserve's liabilities medium of exchange. If you were to do that, then inflation would take off. And in short order, we would all be miserable. You would trigger something called Gresham's Law. The bad money would chase out the good, and we would go into inflation. But as long as the Fed's liabilities are not legal tender, as specified under the Federal Reserve Act, the current system remains intact.
So that's a good thing, potentially.
I think it is a good thing, but there are people that are proposing to end the system, and that of course is in the politicians' hands, and economists, all we can do is react to it once we see it.
You hear about these, modern monetary theorists. We did a whole show one time. I think we were talking about it with you. Who follows these people? Are they really gaining traction? I mean, fringe politicians and on the left maybe, but do people really take them seriously? I mean, I know they do, but
Well, here is the deal. We already have substantial evidence that massive over-indebtedness has this deleterious effect on growth. So in actuality, we've already tested MMT and it's failed. If you think back to the great Sir Isaac Newton, gave us the laws of gravity that prevailed until Einstein's theory of relativity. Newton was an alchemist, and he basically believed you could mix mercury and iron and produce gold. And so he started doing it in very small quantities, and he didn't get the reaction. So what he did is he kept moving to larger and larger quantities, but it didn't matter the size of the mixture. The relationship was not workable. And so in essence, we've already tested MMT and it's failed. And in my opinion, if we were to adopt MMT, then we would further worsen the law of diminishing returns. It's already failed, in my opinion. But there are some people that are strongly advocating it, but it would definitely take us in an even worse direction than we're currently heading.
Yeah, and I think in a lot of ways, the last year has been an experiment in MMT. I mean, they're just spending money just because
really is.
Of a crisis.
Said, Josh. Absolutely.
And it's helping, the super rich or whatever stay afloat. But if you look at, I was thinking about this, if you look at the average person, just talk to your neighbors, friends, the misery index is growing. People are not happy, and they have this angst.
Well, if we had maintained the growth rate that we had done historically in the second quarter, our real per capita GDP would be $73,000. It was actually only 58. And so as we've become more over-indebted, the economic growth rate has fallen. And what happens whenever that occurs is that the dispersion between the highest and lowest income bracket gets worse. And so we take the debt on with the best of intentions, but the net result is it makes the results worse. And so the combined coordination of monetary and fiscal policy have adversely affected those folks with moderate and modest means the most.
Well, that's a great way to conclude a fascinating interview with Dr. Lacy Hunt. Dr. Hunt is with Hoisington Investment Management Company, and anything you're promoting that you'd like to share for our listeners, is it hoisington.com? Is that your website?
We make our quarterly newsletter. We put it on our website, hoisingtonmgt.com, as a public service. So if you want to read our letters, which come out 4 times a year, they're available.
I'm on there right now. And hoisington.com just goes there as well. So thank you so much, Dr. Hunt. Fascinating interview. Folks, tell all your friends.
Josh, right.
And give us a call, 888-988-JOSH, if you want the 45-minute ultimate financial game plan. And share this interview with your friends. Hit the subscribe button on YouTube and share our Spotify and iHeartRadio podcast. Thank you so much for joining us. This is Josh Jelinski. Thanks for watching and listening.
The preceding program was sponsored by the Jelinski Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jelinski or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jelinski.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jelinski and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Advisory services offered through Wealth Quarterback LLC.